Plain and simple investing VOO explained. The ultimate beginner's guide. Everything you need to know about VOO in under 10 minutes. Invest in America's 500 best companies with one purchase. VOO is a simple one-stop stock investment that lets you own a piece of 500 of the biggest U.S. companies, making it easy for beginners to grow wealth over the long term. What is VOO? Understanding the basics of America's most popular index fund. The basics. Vanguard's S&P 500 ETF tracks the S&P 500 index. Ticker symbol VOO. What's in the S&P 500? 500 largest U.S. companies. Top sectors include tech, health, and finance. Includes Apple, Microsoft, Amazon, and many others. Low costs. VOO features an ultra-low expense ratio of 0.03%, meaning just $3 per $10,000 invested annually, far below actively managed funds. This cost advantage compounds over time, boosting net returns for long-term holders. ETF that tracks S&P 500. VOO is an ETF, exchange-traded fund from Vanguard that tracks the S&P 500, an index of about 500 large U.S. companies like Apple, Microsoft, and Amazon. Why VOO is perfect for beginners. Low costs, diversification, tax efficiency, and ease of use. Own 500 companies at once. When you buy one share of VOO, you are indirectly buying very small slices of all those companies at once. Instant diversification in a single purchase. With VOO, you get passive and long-term growth because it is passively managed. It just follows the index instead of trying to pick winners. It is designed to be a long-term, low-maintenance investment. The simple philosophy, VOO is built to follow the overall U.S. stock market through the S&P 500, rather than trying to beat it, which keeps costs low and the strategy straightforward. It's the set-it-and-forget-it approach to building wealth. Why VOO is perfect for beginnings. Key benefits include low costs, diversification, tax efficiency, and ease of use. Why VOO is cheap to own. 0.03% expense ratio, roughly $3 per year for every $10,000 you invest. Many actively managed funds charge 0.50% to 1.0% or more, $50 to $100 per year on $10,000. Over decades, that fee difference compounds, keeping an extra 0.5% to 1.0% per year can mean tens of thousands more in long-term returns. Diversification, spreading out your risk. By holding 500 companies across many sectors, VOO reduces the risk that any single company can severely damage your portfolio. Market cap weighted. Bigger companies make up a larger share. Strong performers naturally grow while weaker ones shrink. Benefit from long-term growth without researching individual stocks. Why diversification matters. Risk mitigation. By not putting all your eggs in one basket, you protect your portfolio from a single company's failure. If one stock in a fund drops significantly, the others can help balance out the loss. Exposure to growth. Participate in the growth of various sectors. Consistency. Diversified portfolios tend to have less volatility. Tax efficiency. ETF structure avoids distributing lots of capital gains each year. You typically owe taxes mainly on dividends and gains when you sell. No surprise capital gains payouts every year. More of your money stays invested and compounding. Liquidity and ease of use. Trades like a stock during market hours. Very high trading volume and tight bid-ask spreads. Easy to buy or sell without moving the price. Start with one share or fractional shares, no big minimum. Growth, dividends, and real numbers, historical performance, and concrete return examples. Historical performance overview. 5-year annualized return of 15 to 16%. 10-year annualized return of 13 to 14%. Since inception average of 14 to 15%. Remember the rule of 72. States that if you average 10% per year, you double your money in 7.2 years. Quarterly dividends. VOO pays quarterly dividends, which you can reinvest. Reinvesting dividends is a major driver of compounding over many years. This is how wealth really builds. Key insight. Over the last 15 years, VOO had positive returns in 13 out of 15 years. This is why a buy and hold investor benefits from staying invested through both good and bad years. VOO versus sector ETFs, tech, energy, financials, etc. Idea: VOO equals whole market, sector ETFs equals one slice of the market. Over about the last decade, VOO's annualized total return has been around 13 to 14%, which is very strong for a diversified fund. Some sector ETFs, like technology funds, have had higher returns in recent years, but with much bigger ups and downs. Risks with sector ETF: can outperform in certain cycles, but crash harder when sector falls out of favor. Often experience deeper drops, 30 to 40% in rough years. Harder emotionally and financially for beginners to ride out. VOO has advantages, owns many sectors at once for smoother long-term growth, better risk-adjusted returns for hands-off investors, lowest expense ratio at just 0.03%. Risk, volatility, and how to think about them. VOO can drop 20% or more in a bad year. This is normal equity market volatility, not a flaw. 10-20 years is the key time horizon. If investing for retirement, drops are usually temporary bumps along an upward trend. Stay put. The best strategy is to hold through both good and bad years. Time in the market beats timing the market. How beginners commonly use VOO. Simple, proven strategies for long-term wealth building. 1. VOO and chill strategy. 2. Dollar cost averaging. 3. Retirement accounts. VOO and chill strategy. Many investors use VOO as their core holding. Buy regularly, reinvest dividends, and hold for decades. Set it and forget it. Dollar cost averaging. Invest a set amount every month or paycheck. This smooths out the price you pay and reduces timing stress. For example, buying $500 a month of VOO. Retirement accounts, tax-advantaged growth. VOO fits especially well in IRAs, 401ks, and taxable accounts for passive investors. S&P 500 updates and rebalancing. Understanding how and when the index changes. When you own VOO, you don't have to worry about updates and rebalancing your baskets of stocks. It is automatically done for you when S&P 500 adds or removes companies for that index. The schedule: when? Quarterly rebalancing. 4 times a year: March, June, September, December. Changes become effective on Monday after the 3rd Friday. Ad hoc corporate actions. Changes can happen anytime for mergers and acquisitions, spin-offs, or bankruptcies. The criteria: why? Market cap 18.0 billion plus unadjusted market cap. Profitability: positive earnings over 4 quarters. Sector balance. In 2025, S&P 500 was updated to add and remove companies based on certain criteria. Based on this, VOO automatically buys and sells those stocks 4 times a year. The impact of rebalancing of S&P 500. The index effect. When a stock is added, every ETF like VOO must buy it immediately, creating temporary demand surge and price pop. Selling pressure. When stocks are removed, index funds are forced to sell their shares, creating downward pressure on the stock price. Is VOO right for you? Of course! Owns about 500 of the largest U.S. companies. Simply tracks the S&P 500 index. Very low fee of 0.03%. Broad diversification across many sectors. Has historically outperformed most similar actively managed funds over long periods. Highly liquid, tax-efficient structure. Pays quarterly dividends. Offered by Vanguard. Buy regularly and hold for decades. Support us by clicking on the like button and subscribing to our YouTube channel.